As we're in the liability chapter, so I want to make sure that you understand some of these journal entries that are in 724. You'll scroll with me down here to truck and then capital lease liability. Let me try to explain what this is. Uh, Very often we'll run into companies who are buying a truck, and instead of signing a note on the truck, they'll sign what is referred to as a lease. Well, leases are come under very close scrutiny by accountants, and we basically classify leases by a four-step process, and we determine whether or not they are in fact a note or not. Okay, because the very essence of a liability, guys, is that it's an obligation. So if you're signing a lease where the majority of the truck gets paid for while you're paying for the lease, then you're really just buying the truck, right? You're not leasing the truck. And if you are, typically, there's this real low salvage value kind of at the end where if you pay that, then you own the truck anyway. So you're really just financing the truck, guys. So in essence, accountants say this is not in essence a lease. It is really a note. Okay, and and so it's an obligation that we have to pay. Now keep in mind that if we have a lease on a piece of property, on a warehouse, if you will, and we have a lease on it, we're paying rent per month. We don't record that as a liability. We we say, oh no, if we want to vacate the warehouse, we can at any time and just not pay rent. So we don't feel like there's a whole obligation there that's big enough to actually have to record the obligation. We feel like that rent can be broken and gone because there's certain circumstances in certain lease contracts that can happen. But when it comes to a truck, you can manipulate and you can sort of make a note really sound like a lease. Okay, and really it's too much of an obligation not to record. So be aware that these are recorded at their present value, and they give us this in the problem 110, and we go ahead and identify that as a capital lease, and that's basically our way of saying, hey, look, guys, this is a note. Okay, if we roll down here to B, we have some wages here that we are not paying right now, but I want you to know and understand that wages expense is very often higher than wages payable. Why is that? Right? Because wages payable is the amount of money that goes to the employees, whereas all of the amounts that they take out of your paychecks, then those go into withholding liabilities, and they've just put various descriptions here, guys, because this is Social Security and unemployment and income tax, and there are many, 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 many type of withholding deductions. And if you're getting a paycheck at all, you'll understand that completely. But these deductions are recorded as payables, and this is the payables chapter. So I want to make you aware that the amount of expense that a company incurs on you is a lot more than they're paying you. And it's a lot more even than they're withholding from you, because remember, they have to pay an additional unemployment amount, an additional Social Security amount for you. So there are many more withholding liabilities associated with wage expense than you may have once thought. Okay, so that's what this entry is all about, to just give you exposure to that. And guys, if you were taking an accounting course that was not MBA level and it was more of accounting MBA, they would have all these withholding liabilities listed, and you would have to kind of calculate how much each one was, and all that. So you don't have to do that in this class, and that's why I like this author. He said, boom, he just puts it all in the withholding liabilities, to give you an opportunity to be exposed to it, just to understand and know what your payroll department is basically doing, is recording a bunch of payables. And then, those different amounts for Social Security and unemployment and income tax, they're all payable at different times, differing times, according to tax law and Social Security tax law. And believe me, Social Security is a tax. We issued a bond here in C. We're issuing it at a premium. Notice the premium on bonds payable is a credit, not like a discount, which would be a debit, right? And so here we have a bonds payable, and notice that when we issue a bond for premium, that means we're getting more money for the bond than the face amount of the bond. Okay, what is this in D here with this estimated warranty liability? Well, what is that? If you have, you're making an adjustment to it here, but I want you to understand that warranty expense is something that you would have to estimate and record if you had appliances or cars that you were selling and that they had warranties on them for a number of months, right? Or usually it's like 3 years or something, or maybe 5 years. But those particular warranty, those amounts that you're obligated to pay just in case something goes wrong, can be reasonably estimated based on past experience. So you can kind of come up with usually a warranty expense based on a reasonable estimate of what it is that you may have to pay out in a warranty. So it could be for, like I say, trucks, automobiles, and appliances would have, companies that make these most certainly would have warranty, an estimated warranty liability. And here in D, has paid careful attention to the wording. What they're doing here is they're actually making an adjustment to warranty expense, and they're decreasing the liability. They're actually saying, look, we've looked at this and we think that we need to make an adjustment here. Usually this is done again at the end of the accounting period when the auditors come in, whether they be internal or external auditors, and they're making an adjustment to it. They're saying, hey, look, we're not going to have quite as much warranty as we thought we might have. So they're making an adjustment to that. Okay. Now, we're retiring a bond in midstream here in E. When we retire a bond, we have to take the bond off the books. What does retirement of a bond mean? It means that we're paying cash for that bond to get it off the market. So when we pay cash for that bond, the amount that's included there for the cash, right? We're getting $43,680 for having to pay for that bond. Okay. Now on our record though, we have bonds payable of 42, and we have discount on bonds payable still left on the books. So we have to remove those. Okay. And then the plug figure here, guys, is the loss on the retirement of the bond. So we have a debit here we have to kind of make equal the credits. So we're going to record a loss here on the retirement of those bonds. And remember, that loss would go below income from operations on the income statement. And here we have an estimated healthcare expense. And what is this? Right? And this is if you have employees that you're covering for healthcare, and you have an obligation to pay for their healthcare and the expense of their healthcare. Remember that a lot of bigger companies used to not only cover their employees' healthcare, but also cover their retirees' healthcare as well. So a lot of big companies did this, and this is negotiated with the unions in many cases, where they have this huge estimated amount that they have to pay out in healthcare expense. And so companies kind of estimate that. And in this particular problem here, we're talking about some of it being current because that's what you're going to pay out or estimated payout this next year. And then beyond that, you're going to have a good bit of estimated liability for non-current. Right? So they're reinforcing the concept of current and non-current, just like they did with non-current assets. They're now doing it with liabilities here as well. Now we're going to scroll down to 726, and we're going to go into this one, and we're going to talk about unearned subscription revenue, we have an issuance here, right? What was this? A newsletter, I believe it was. It's a monthly newsletter, right? And you're paying $60 a year for it. There's 500 subscriptions, and this is the amount of money, guys, that you're getting in when you sell in August. Is the amount of money you got. Well, how do we book that? See, you haven't issued the newsletter yet, right? So how do you book that? Well, you're getting the cash, right? You're getting it up front, but we hesitate to actually record revenue on this because we haven't earned it yet. So it goes into unearned subscription revenue. Well, what kind of an account is that? You have to kind of remember what chapter we're in. That unearned subscription revenue is a liability. So this is an unearned amount that is recorded as a liability until, in fact, it then, right, the newsletters are being issued. So when they start being issued, then we can change it from unearned, excuse me, to earned, right? It's an unearned to earned. So in this case, we had 350 subscribers that actually was able to get the newsletter for the month of August. But then we had, the others, all 500 got it in September and November, and October, November, December. So for those 4 months, we're paying out $60, to 500 subscribers. Well, we're not paying them out. What we're doing was we're issuing those newsletters. So we are then earning that revenue. So in the first month, we just had 350 at 1 month. And then in the next 4 months, we had 500, right, at 60. So at 4 months. So when we take this and add it together, that's the total amount of subscription revenue that we have earned, right, from August through December. Now that's on the August sales. So that's sales for August. Okay? But this is just kind of a way to introduce to you, how unearned amounts, if we hesitate as accountants to even though we've got the cash, we still don't recognize that revenue until a critical event has taken place. And that critical event is that we've earned it. In other words, we've issued a newsletter. So they gave us money to do that, and now we've done that. And once we've done that, that critical event took place, it's time then to record it.